With all the toing and froing and hand-wringing that has been going on lately about the apparent collapse of the current asset bubble that we've just experienced, it has got me thinking about the historical role of bubbles that they play within markets, but more specifically to look back at those bubbles that I've seen, and one which in particular stands out in my memory simply because of the role and part it played in my trading career. And I'm referring to the Japanese asset bubble that occurred in the 1980s. And this bubble, as a keen watcher of Asia for decades, fascinated me. And it fascinated me not only for the economic reasons, for the extraordinary growth it experienced, but also the cultural and racial undertones that largely accompanied it. And they're undertones that not only occurred in the West, as we will see, but also in Japan, because the boom in Japan in and of itself represented, to my way of thinking and my observation, a renaissance in, I'll use the expression, national pride. To the Japanese, they saw it as them recovering. In the West, it was surprising simply because a generation and a half earlier, Japan had literally been bombed back to the Stone Age. Yet within a generation, they were beginning to gain economically on the West. And this troubled the West enormously because they could not understand how that could occur. Yes, there was a massive rehabilitation and rebuilding program in Japan after the war. But there was still the cultural element of how people who'd been so utterly defeated picked themselves up and got going again. And intriguingly, it crept into aspects of the Western psyche. It appeared in popular media. Michael Crichton, who also wrote Jurassic Park, produced a book in '92, just as this sort of Japanese boom was coming to an end, called Rising Sun. Japanese characters, landmarks, villains, characters began to appear even in Hollywood. Die Hard, which by the way is the best Christmas movie ever, took place in the fictional Nakatomi Plaza, which was a building owned by a Japanese trading company. And if you were involved in business in any way, shape or form, this was compulsory reading. Akio Morita's Made in Japan, The Story of Sony. It was considered that everybody should have a copy of this to understand how somebody started a business the size of Sony and the reach of Sony literally on their kitchen table, and what cultural elements and what structural elements enabled that to occur. But as I said before, there was a racial undertone to all that was occurring, particularly in the US, because the US were very, very much on their back foot when this began to occur. And in particular, this is an article from 1988, and it uses the expression economic Pearl Harbor, and it's referring to the notion that the Japanese, because of their inherent wealth, went on a buying spree throughout the US, and their asset acquisitions were absolutely extraordinary in size and scale. And this is just a little timeline of some of them. The most disturbing for the Americans from my memory was in 1989 when Sony bought Columbia Pictures for $3.4 billion in cash, not stock, not some complex hybrid deal worked out by a mergers and acquisitions team. They wrote out a cheque. And I remember at the time how much this disturbed the Americans, that this could actually occur. But if we look at the history of this asset bubble, the fixed notion for a start date and an end date that people give is 1986 to 1991. I disagree with that. I think it's wrong. it completely undersells the timeline of events, and it does what many people do in that it assumes that events they are perceiving or have taken part in have only just occurred. If we actually look at the Nikkei, and we'll use this as a proxy for wealth, you can actually see that the Nikkei begins to really get going early 1980. But even this is a mistaken impression, because what we're seeing here is a compression of scale. It really actually gets going in 74, 75. So the momentum of this bubble was very, 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 very well established before we hit this 1986 sort of, look, I'll call it a fictional landmark. And we can see this when we look at relative comparisons. This is a relative comparison of the Nikkei and the S&P 500, looking from 1983 through to 92. And I put this up because I want to give people a sense of, for this period of the bull market that we all thought was a US phenomena, how much the Nikkei outpaced the S&P 500. And in particular, how much it outpaced the S&P 500 post the 87 crash. And talking to Japanese traders I knew, the fact that their market shrugged off the 87 crash was to them a sign of national pride. It was evidence of the fact that the Japanese way was a better way. And if we take a longer look, you get a sense of what I was talking about with the outperformance. And I've taken this from the end of the bear market in the US in the mid-1970s. So we get a better jumping off point, better starting point for comparison. And you can see that the Nikkei continually outperforms the S&P 500 for, from 76 to 1990. Then the asset bubble in Japan unwinds and it all goes horribly wrong. But you can see that the artificial start date of 1986 is not actually correct. It's not actually fixed in any form of data. If I was to try to generate a point for the kicking off of the bubble, it would be this point of relative comparison where the Nikkei begins to outperform the S&P 500. When I was putting this together, it reminded me of a collection of outrageous facts you would hear about assets in Japan at the time as we got news of what was occurring. You have to think back. This was not a time when you could open up the internet and simply look at things, where everything in the world was open to you. These reports came back from news reports from brokers I knew, traders I knew in Tokyo. And these are a few of the more bizarre ones that at the time absolutely staggered us. Tokyo real estate was selling for $139,000 per square foot, 350 times the equivalent space in Manhattan. The land upon which the Imperial Palace sat was reckoned to be worth as much as the entire state of California. I've seen the Imperial Palace, it's not that big. The Japanese property market was worth 4 times the US property market. 9 out of the world's 10 largest banks were Japanese. Half of the world's stock market capitalisation was traded on the Tokyo Stock Exchange, not the NYSE, on the Tokyo Stock Exchange. Japanese investors owned 45% of the prime downtown real estate in LA, a fact that absolutely freaked the Yanks out. And one of my favourites, golf club memberships traded for millions of dollars. These memberships were traded effectively on an exchange of which the total value was $200 billion. But this leads us to the notion of what generates or causes such an asset bubble. And these few facts I've alluded to give you an indication of why that might be. The driver is real estate. If you've ever been to Japan, you will know that despite its enormous density, it's actually a very small country. Not a lot of the land is usable or arable. And between 1956 and 1986, the value of a single parcel of land could increase by as much as 5,000%. But it was not just a one-trick pony. The other element was soaring corporate profits. And these are just a few I dug up. These are dramatic lifts in profitability in 5 years. The West had long thought of Japan and Japanese industry as imitators, when in actual fact they were innovators. And this enormous growth in profitability shows that. As sort of an anecdotal example, when I was young and you got your first car, the stereo you wanted to put in it was a Pioneer stereo. It was a Japanese stereo. This was the default setting for everybody. All of a sudden, Japanese electronics had gone from this sort of, let's assume this, they were looked down upon, to all of a sudden that they were leaders of the pack. And they were innovators in what they did. And this began to appear everywhere. Japanese cars began to appear everywhere. Japanese electronics, Japanese heavy machinery. It was very, very much this symbol of rebirth and reinvigoration. But underlying that was this notion of a trade effectively in intangibles, what we see traditionally in a bubble, and that is speculative behaviour. As an example, the cross-ownership in Japanese companies lifted from 39% to 67%. And this is reflective of a cultural approach to doing things that seem to be, on our observation, a uniquely Japanese thing. It seemed that Japanese industry worked cooperatively and cohesively. And by that I meant they often took very, very large shareholdings and traded those shareholdings in one another. Think of it this way. This would be like our big four banks having as their majority shareholders the other three major banks. And so it presents this trading block. And intriguingly, this sort of trading meant that each Japanese major company had a share and FX trading group. So the percentage of turnover that was covered by this internal trading rose from 19% to 39%. It effectively doubled. And it did intrigue us that every major organisation had their own trading desk. It would be like General Motors having a banking and stock market arm. It would be like Ford having a general stockbroking and banking arm. It was a very, very different concept to us, but it fueled, in concert with the monetary policy of the time, and property values, this capacity to generate nominal wealth. And the unfortunate thing is when you generate nominal as opposed to real wealth, it can, as we have seen just recently, evaporate dramatically. This raises the question of what brought it to an end and what are the common features that we see across bubbles, because bubbles have common features. The end for Japan came in 1990-91, when it all just came to an end. The Japanese then endured effectively 2 lost decades where nothing happened. Their market simply drifted, their asset prices were moribund. In terms of this part of the economy, they were stuffed. They still continued to build things because unlike many economies in the West, The Japanese still have a manufacturing base. They still build things that other people want. So their wealth is not completely built upon intangibles that don't exist. But what this shows is the damage that can be done when bubbles collapse. And you can see it's only 2012, 2013 that the Nikkei started to bottom and move up. But there were lost decades in there. And in terms of the causes, what put the brakes on? It's really quite simple. This is the equivalent of the Japanese Fed funds rate. You can see in 1989 they faced an inflationary problem, so to slow it down and lift the handbrake, they did what all governments do. They resort to the only lever they have, and that is interest rates. And interest rates effectively tripled. And because the economy was so heavily geared, and there was gearing upon gearing, because when you have an increase in asset value, it allows you to borrow more. So you borrow more, buy more, and then borrow against what you've just bought. So you effectively have a deck of cards that comes unstuck. This is very much what was seen in the GFC. At the moment the cost of doing business goes up, people find it very, very difficult to service debt. And this is the thing that occurred in Japan. With the inordinate gearing based upon quite ridiculous asset valuations, any slight perturbation or wobble that stops those asset values from forever going up brings the entire thing crashing down. You can also see the effect of this in the currency. The yen had been declining for some time, which made Japanese goods very, very cheap. That combined with their economic power from the manufacturing meant that, of course, they were going to flood the world with their products. This brings me to the notion of lessons. And all bubbles teach us lessons. And here's a shock for everybody who has spent more than 2 minutes in a market. The lessons are all the same. If I was doing this on, let's say, the South Sea bubble, the lessons would be exactly the same. They would not be any different, despite the fact we're displaced in time by 3 centuries. And here's the most remarkable feature that the majority of people simply don't learn. All bubbles end. It's just the way it is. There is no way around this as a fact. The Japanese, for example, were caught up in the notion of they would present this as the Japanese century. Unfortunately, it lasted less than a generation. They were also caught up in the notion of, yes, but this time it's different because we are Japanese and we make things. None of it is ever different because bubbles at their heart are driven by a speculative fervour. That speculative fervour is a function of human beings. Human beings are no different now than they were 40 years ago, than they were 300 years ago. Here's the other shocking news. All bubbles end in busts. Again, that is just the way it is. When you have overinflated asset values that are based upon rampant speculation, then when it goes wrong, it goes horribly wrong, as people who've invested in all sorts of nonsense bits and pieces in the past 2 to 3 years are finding out. All of these are emotional events. Whilst I've gone through this and I've said, look, these are the points of fact that we have about this, that I think it began on this day, and that the causes of it were this, and some of the more extreme examples of it were this. At the heart of the matter, all these are emotional events. They are that fine balance between fear and greed. And when it tips one way or another, dramatic things occur. But it will always tip one way or another. Simply looking at a long-term chart of an index will tell you that this occurs. But unfortunately, not enough people do that. And finally, Whilst there are certain things we can point to about how, where, why, what, all bubbles are fundamentally illogical. You can build your narrative fallacy as to why you think it is logical, but at the end of the day, that is your story. That's not the market's story. The market's story is price and what is happening to price. And without a doubt, and without any form of argument from anyone, that is the only story that matters.